Hello everyone and welcome to Your Property Potential, your easy to understand podcast for everything home loans and property finance. I'm Hilary, definitely not a property finance expert, but luckily I've got Ben and Paul Williams here from Mortgage Choice, father-son mortgage broking duo.
Thanks for the kind introduction, Hilary.
Thanks, Hilary.
My pleasure. So before we start, we just need to say that this podcast is not financial advice. It doesn't take into account any of your own unique circumstances. So if you are looking at making some decisions about your home loans, property or finances, please chat to your own trusted advisors. So guys, we're actually in part 2 of how to save money on your home loan, which is such a big topic at the moment after 2 years of cash rate rises, interest rate rises. People are freaking out. I had a friend the other day come to me and say, I cannot afford one more interest rate rise, one more. And when people are actually telling you that, you know that that was true 3-4 months ago, right? That they were struggling 3-4 months ago. Now they're actually starting to tell people. So there's lots of people struggling out there. So I think it's a really, really great, we've covered some really great tips already in part 1. So we covered repricing, which I went on and on about because it is absolutely my favourite strategy for home loans and saving money. Now, sometimes it's not always possible. Sometimes your bank doesn't want to come to the party. Now, we love our banks. We love our lending partners. And, you know, my dad's from Argentina where they do not have a stable banking system. They do not have a stable economy. And you can see what that does to quality of life. So we are very, very happy that we've got a strong
we're very lucky in
here.
Australia. It's actually, look, our lender partner's fantastic on, for example, the Mortgage Choice panel, and most brokers will be the same. It's a very responsible lending system in Australia, great prudential regulation. The other thing is the competition, and that's what the ACCC wanted to see, is lots of competition. And people may not realise what other options are available to them, aside from their current loan and bank and lender. So, but we always go back to the current lender. Whoever the customer is, they come to us with a new client or existing, always go back to the current lender and have a conversation.
So that's the repricing, right? So
yes,
that's
right.
first step.
You've got to do that first.
Yeah.
Let's face it, you've got to do that first. Give them an opportunity. I would like that, you know, and I think it's out of respect for that lender.
It's better for the client as well.
Absolutely. Because sometimes it can be a hassle. It can be a hassle to move for some people. Equally, if you get a rate discount like you did recently, Hilary, you don't have to do anything. It actually happens automatically and happens same day.
Don't get me started on repricing again, Paul. It's so good, but
the point is, it's a very competitive market, which is great. That's exactly what the government wants and what people want. We want good competition. Equally, we want our lenders to be strong. Yeah. They need to make profit. Of course they do. That's important. Every business does. But given the competitive nature of mortgages, so banks actually, and they're not crying poor. They make good profits, especially perhaps the big four. But you know, they don't make as much money as what people think out of mortgages, and they can't. You know, their margins aren't that big, and their costs have gone up as well as the same with broker businesses and any business. So we've got to really make sure that we shop around. People need to shop around. Talk to the trusted advisor. Talk to your broker. Make sure you're getting the best deal. Be amazed what's available. And one of the things I wouldn't mind chatting about is also the structure of loans. How do you structure a loan for repayments and things like that? Because it's not, you know, people got different objectives, and even through different parts of their life cycle, they've got a different objective. You know, for example, if someone's about to have a second child or a first child or whatever, or do some home renovations, or they want to save for the next property, sure, we can do a refinance, no problem. But it's also having a conversation with them about what's your objective? What are you actually trying to achieve now and over the next few years? Oh, I'd love to buy... Like, I've got 2 doctors at the moment, came to me the other day, earning great income, both in hospitals, professionals. They wanted to move their repayments from principal and interest to interest only. And I had a conversation. Why? Why do you want to do that? Well, we want to do 3 things. We want to free up our cash flow to make some home improvements, like kitchen, garden. Awesome, fantastic. What else do you want to do? I want to do some travel later in the year. That's great. And then the other person, they said that they want to buy a second property. So I want to free up cash. So what I'm saying is, when people considering refinancing, it's also about what are your objectives, and then what's the structure of the loan. Like my key objective is cash flow for the next 2 years, for example, that in those two doctors. So great, we're going to structure your loan with the right lender, with the right interest rate to allow you to achieve your objective.
So if someone comes to you and they say, Paul, I need my home loan reviewed, the first step for you is we're going to go to their current lender and say, what can you do?
Yes, absolutely. Gives them an opportunity to leave the lender. But also, do you know what's interesting? You also got to get to the right person or team in that bank. And they're all a bit different. Sometimes we bypass the whole system and go straight to the retention team.
Yeah.
We want no mucking around. We want your best rate for the client. And then the bank, you give them an opportunity to then, whatever their profit objectives and repricing and rates and all that stuff, give them an opportunity. And we may or may not like the answer, but we also know the competitive context. So we sort of know whether it's reasonable or not.
And I think that's key, because I don't know what's reasonable as a non-property finance person. They come back to me with a tiny discount. I'll be like,
that's where we come in.
That sounds good.
We can help say, do you know what, Hillary? That's actually not a bad deal. Stay.
Yeah. Or that's not a great deal. Go.
Yeah. Or well, do you know what? We're going to go back, and we've got Fiona on our team who's like a dog with a bone. She might go back 3 times to the bank and say, no, you know, this other lender over here is offering 50 or 0.5%, which is like $100 a month difference to you. So we're going to have a go. And it might take another day to do that, but we're going to do it. So it really depends on people's objectives. I reckon people just want, like with anything, I suppose, people just want a fair deal.
Yeah.
Don't you? Is my interest rate and repayments fair and reasonable? And then the second part of that is, well, what are my objectives? And everyone's different. That's why Ben and I, we love having those conversations. What are your plans?
Yeah.
You know, it's not just about today. It's also, well, you know, what are your plans for next year? You know, 2 years, whatever.
And I think that's a really big deal, because when I was a first home buyer, I just went straight to, I've been a Dolomite since prep, and I went straight to Combank. Because I didn't know. Because you don't know. I just thought this is a home loan and you get a home loan. I didn't know that home loans can be highly personalised, highly tailored, going out and finding what's going to work for you, especially when you're looking at refinancing or buying that next home, that it can be so personalised to what you, okay, I want to travel, I want to renovate, I need cash flow. All right, let's switch up the structure of the loan. So I didn't know that because you just think, home loan, okay, my bank's got it, I'll go get a home loan. So first step is to go to their bank, see if you can do some repricing, get them a cashback, whatever else. If the bank isn't coming to the party, right? Let's just say they're offering nothing, you've gone back, you've tried to fight, nothing, right? They're not coming back with anything good. Then what do? You're looking at refinancing then.
Yeah, that's right. So again, having that conversation about, well, what are people's objectives? What's important to them? And then finding the right lender to suit them. Now, what's the right lender? You know, so for some people it might be, and it depends on people's circumstances. If you're self-employed, you're employed, what's the loan to value ratio?
Yeah.
Have we done a valuation? Because banks price mainly on the risk to them. So the loan to value ratio. It may be the occupation type. Banks love medicos, for example. They'll lend 95% of the value of a property for a medico, for example.
I don't think a lot of people do know that as well. Is it just medicos, or is it other professionals?
Oh, no, other professionals. Yeah, other professionals
so like
as well. Yeah, Ben does lots of chartered accountants and... you know,
and they can get a better deal.
Then there's all these different types of medicos as well. So you've got your GPs or your dentists, but then you've also got psychiatrists and even physiotherapists.
Right.
Some banks look after physiotherapists more than they look after.
But is that lender to lender?
Yes.
Correct. Right. So some lenders will look after physios.
Yes,
some
and
lenders
some
won't.
don't. That's right.
Right.
I
so
know,
it's
crazy.
like there's so much involved in
that's
getting
what
a good
broker.
deal.
Yeah, there is, and people generally speaking don't know this or not armed with this information. And as brokers, brokers in Australia are very good. That's why I guess, well, not pumping up our own tyres, but 70% of Australians use a broker now, and that's massive. It used to be 25% 10 years ago, so it's growing like it is overseas. So our job as brokers, as professional brokers, is to understand people's objectives, and then give them some choices.
Yeah.
Give them the choice. So so back to your earlier question. So if their bank doesn't want to come to the party, we prepare a detailed comparison, and we've got a best interest duty by ASIC, which says we must as brokers highlight the best possible interest rate for that person under their circumstances.
Yeah.
So we do that, but sometimes it might be a bank that someone's not heard of, or a small bank. No, I want an ethical bank, or I want this, or I want that. I want a bank that doesn't lend to fossil fuels, or So again, it depends on people's objectives. So then we outline the comparison rate, fees, repayments, the process, and let people decide. Now, for most people, over the past probably 2, 3, 4 years, we've done thousands of refinances. So we'd like to think we know what we're doing and which banks are best for that. And we typically can save people through the refinance process at least 0.5%, sometimes more. Now, that might not sound much. We'll just set it like that. But when you're talking $60,000 to $100,000 to $200,000 over the life of the loan, over say a 30-year term,
it's a big deal.
It's a heck of a lot of money.
Yeah.
So it's well worth doing.
Yeah.
So we lay it out. And Mortgage Choice got some good software. It sort of says, here's your saving after 1 year, 5 years, 30 years, and we show people, is it worth the effort? So what's the effort? We might have to get some pay slips and bank statements and everything together. It's not too hard a process. Some of the banks are really good at the moment. They're making it quite easy for people because they're hungry for business, and we get the job done for people based on their objectives.
That's the best thing. You can kind of say, Ben, can you do this? And you go away and do it. Ask for what you need, and then it's kind of done. Bam, which is really, really good. I remember, Paul, you were telling a story maybe, ages ago, but you mentioned it's always stuck with me, that you got a home loan for a couple, and then about 3 years later they came back for a refinance, but they'd added a couch loan, a car loan, a fridge loan, like all these different tiny loans into their finances. Now, your story on that was massive because tell us what happened.
Yeah, that's right. It's funny. The good old Harvey Norman, they're great prices on fridges and all the stuff. So they did their finance through some of their offers, which is fine at the time. But we took the opportunity to revalue their home. So their loan to value ratio came right down. So originally,
because their property value had gone up.
Property value went up, and mortgage came down a little bit. Don't forget, it's hard to get a mortgage balance down in the first few years.
In that first 10 years or so.
Yeah, it's mainly interest, of course. So, got the loan to value ratio down through doing a couple of different valuations. Doesn't cost the client anything. And then we're able to consolidate all of the debts you mentioned. So the fridge loan, the car loan,
because they were on massive interest rates. I remember you saying, like, the fridge loan, the car loan were huge interest rates.
Absolutely.
And then you're bringing it into the home loan. And I think...
Yeah, the saving was about $1,200 a month.
Massive.
Which is huge. So then what I said to them, and don't forget the other thing is this, car loans, for example, in this case, they're usually 5 to 7 years. And it's important that people, if you do roll it into your home loan, and home loan rates are up to 30 years. So we've got to be careful that we're not costing them more money. So again, we have the conversation. What are you going to do with that $1,200 saving? So how can we then deploy that to knock off that car loan earlier than what you would have being standalone at a cheaper rate?
Yeah, really important.
So the answer was actually a really good conversation because they said, well, we're going to reinvest most of that saving into paying more off the mortgage. So we're going to pay it off rather than 30 years, we're going to pay it off in 15 years.
Because $1,200 a month onto a home loan is massive. That's going to save you decades.
Yeah, it's huge. And we told them pay fortnightly. And Ben will talk about that hopefully shortly, about the benefits of paying extra and fortnightly and those things. But this was a great story. It's for them, I'm really proud of it because it was life-changing for them.
That must have been a good conversation.
It was really good, yeah. They were just relieved, but they actually didn't know they could do it. So I said, well, why don't you consolidate all this? Because, again, having the conversation, what's your objective? Why? What? What are your plans? What are your worries? How's things going? Oh, we're really tight for cash because I've got this, and this, and they didn't think about it. You get all excited. You go into Harvey Norman, you buy your fridge. Next moment, you've got one of those loans against. Okay, no worries. Let's consolidate it, clean it all up.
Yeah,
and it was very satisfying for them and for us to see them so happy.
Well, let's talk about another type of debt. Ben, you mentioned this just as we were kind of having a little chat before starting. You were mentioning about refinancing HECS.
Yeah, so I guess it's something to look at the moment. Like, I had a client recently where his HECS debt was $300 deducted from his fortnightly pay. So every fortnight, $300. And it's something that people don't usually think about. A lot of people's HECS, it's based on your income, so it gets taken out of your pay. A lot of it's at the end of the financial year, so you don't really see it come out.
You don't notice it.
You don't see it come out. So what I said to that person was, maybe he had a little bit of equity in his home. Maybe we refinance that into the loan. And then what you'll do is keep paying that extra $300 saving that is coming out of your pay into your home loan. And what we figured out was that if he kept paying that little bit extra into his home loan, he'd save 7 years off his home loan, so shaving 7 years off a 30-year loan term. And it worked out to be like a $200,000 saving in interest over the life of the loan, which is massive.
And much bigger than his HECS.
Exactly right, exactly right. So it was like Paul said, it's all about managing someone's cash flow. That's massive, $300. And you're paying off your loan quicker. There's other ways to pay off your loan quicker. You could pay fortnightly. That shaves 5 years off your loan term, saves you thousands in interest as well. So there's a lot of things that you can consolidate. Car loans is a massive one. We've done a lot of credit cards as well. They're like,
because credit cards would be big right now because cost of living has gone up. I heard a massive stat the other day about credit cards, and people are putting everything on their credit cards, and it's just growing and growing and growing. So being able to refinance credit card debt into a much lower interest rate in your home loan, is that what you're talking about?
Correct. And a lot of people have, a very common one, a lot of people have those Latitude credit cards and they just forget about them. They come up on their credit report when we look at refinancing or getting a new loan.
What's a Latitude credit card?
And they didn't know they had one in the first place.
Exactly right.
Oh,
yeah,
they might have gone. Nothing wrong with Latitude. They might have gone shopping, and again, I'm not picking on Harvey Norman. They might have gone to Harvey Norman, wherever, some of those retailers.
Yeah, okay.
And they get offered that. If they don't, they may not have the cash to buy that fridge or couch or whatever.
Right. And people don't
realise. And it comes with all those perks to start with too, and you're like, ooh, okay.
Yeah, it sounds great. I mean, look, a lot of people sign up to those cards. You get the Qantas sign-up points. You get all that sort of stuff, which is fantastic. Nothing wrong with that at all. But I think when people sort of come down and they're looking at getting a new loan or they want to purchase a home, you don't realise that limit actually holds back their borrowing capacity quite a lot. So we've done a lot of consolidation. We've a lot of advice for people to maybe close the card or at least reduce the limit. When banks assess customers on their borrowing capacity, they assume that whatever the limit is, the card's maxed out. You could have
I did not know that. I did not know that. And I feel like there's been, and this might be from an American or a European, residual theory from that, but that you needed credit cards to build a credit score. Is that true?
Oh, not really. I think that's a bit of a myth now.
Yeah, I think that's
so too.
Yeah, banks will look at your now and your future ability to repay.
I thought that people think that you've got to have credit cards to kind of build that credit score. You've got to show that you're good, but we forget, I think, that most people have had phone contracts since they've been in high school. And I think that's something that's missing anyway from I'm a big advocate for financial education because I'm always learning. You guys are always teaching me new stuff about my home loan as well. But we miss a lot of that in high school. We don't do a lot of financial education in high school, which I hate to think that people are going out in the world making financial decisions every day with zero education behind it. And it's something that we share a passion for, is financial education. I know we're very passionate about it. But something to be able to say to high school students, if you don't pay your phone plan, that can have repercussions later on.
Yes.
And you don't think about that.
Absolutely. And then what's one of the things we do with people, we share their credit reports and share those things, so we're making sure we're getting the right outcome for them. People forget they've done things many years ago that might hurt them now as they go to buy a home or refinance and things like that. So we're all over it, Hillary, in terms of educating people and
that's really good.
Trying to get the best deal.
Now, can we do a couple of quick tips on how to, so just some little tips that we can think about how to save a bit more money off your home loan. So Ben, I know there's one you're really, really passionate about, and that is switching from monthly to fortnightly repayments.
Yeah, that's
so
a big
talk
one.
us through that.
I like to, I tell everyone of our clients to pay fortnightly if you can. It essentially means you're paying an extra month's repayment per year, which sort of equates to about 5 years saving roughly off a 30-year loan term.
I mean, you wouldn't notice, would you?
No.
Most of the time.
No, and it's marginal. And
Okay.
look, with paying extra, you can, that little bit extra that you're paying on top of the principal goes into your redraw account anyway. You can always access it if you need it.
Okay.
But it's a little tip. You wouldn't really notice it, would you?
Right, no.
It's a little bit.
Yeah, especially if you kind of build that into your budgeting anyway.
Correct.
Yeah.
Correct.
And what about, we've talked about consolidating debt, we've talked about changing monthly to fortnightly repayments, all that make a big difference. Paul, what's something that you can give us a little tip on saving some money on your home loan?
Just like we said, just making sure that you're conducting a regular review of it with your broker. I think that's really important. So, yeah, the rate is important, but also sometimes it is the type of product you're in. So, do you really, really need an offset account? Can you go a basic loan at maybe a cheaper rate with no fees? But having that conversation as brokers, all good brokers will have that conversation. Making sure rate, but is it the right type of product and loan? Because the bank's got thousands of products.
Yeah.
Thousands. So you've got to navigate through. So that's where your broker can come in. So have a chat to your broker and make sure you're on the best rate and product type.
So people have finished listening to our part 1 and part 2 of how to save money on your home loan. And the next step is have a chat to your broker.
Absolutely.
Yeah. Okay. And remembering that brokers in Australia are their home loan service is free. So you can have a really good chat and not have to worry about the cost.
Yes, that's
true.
true.
That's
and I think
important.
the other thing is, the valuations and getting, good brokers talk about strategy as well and think a bit more broadly. And that enables people to get a better rate, typically through the broker than they could on their own.
Which is really cool. Okay, well, we might finish there. Thanks so much, everyone, for listening to our part 1 and part 2, how to save money on your home loan. If you do, if you're struggling, please reach out to your broker, and we'll catch you next time.
Thanks, Hillary.
Thanks, Hillary.